Okay, so good morning and welcome to Quantuma's third and final joint webinar in this series with IBB Law. I'm Ian Barton and I'll be your chair for today. In this webinar, we'll provide an overview of the challenges in the current market and then look more closely at the advantages and perils of buying a business out of administration. The Q&A function is open on this webinar, so please do feel free to submit your own questions in real time. We've also had a few questions submitted beforehand and we'll try our best to answer most of those at the end. Before we kick off, I just ask for your patience if we do experience any technical difficulties at all during the next hour. And so without further ado, let me introduce you to our speakers for today. First of all, we have Adam Dowdney, a partner at IBB Law. Adam is a well-known and experienced corporate and M&A lawyer in the Thames Valley and West London. He works on all aspects of corporate law, including mergers and acquisitions, MBOs and MBIs, and private equity and venture capital transactions. Adam is respected for his constructive and commercial approach and is included in the Legal 500 Hall of Fame. Following on from Adam, we have Sarah Jackson, who is a partner at IBB Law in their commercial disputes resolution team. Sarah is an experienced commercial litigator who specialises in chancery litigation, predominantly involving the Companies Act and high-value professional negligence actions involving solicitors, accountants and financial advisors. She also undertakes high-value commercial litigation, partnership disputes and contractual claims. Sarah also heads IBB's corporate restructuring and insolvency team, working on all types of rescue plans, restructures and insolvencies. Finally, we have Simon Bonney, a fellow partner of mine at Quantuma and a licensed insolvency practitioner in our restructuring team. With his legal background and technical knowledge, he focuses on providing practical advice and delivering solutions to companies and individuals in financial distress. Simon regularly undertakes appointments, including cross-border investigations and litigation. As a restructuring specialist, he deals with complex insolvency situations where there is an element of potential litigation or problems which require robust solutions. So, having introduced the speakers, I'll hand over to Adam to start our discussion. Adam.
Thanks very much, Ian. Good morning, everyone. Welcome to the third in our webinar series. I'm going to give a very quick overview of what we at IBB are seeing or have seen in the transactional market over the last 8 to 12 weeks and what impact COVID, the crisis and the lockdown has had on the M&A market. I don't think it'd be a great surprise to anyone that M&A market generally is pretty quiet. Clearly, there were deals that were going on pre-lockdown that are still rumbling along, but I think generally processes are pretty slow for the obvious reason that buyers want to understand what the impact is on the business they may be acquiring of the current crisis and how they are trading through and what trading is going to look like going forward. So some deals are rumbling on, some have been put on hold until we get to whatever the new is, and some in some sectors have gone away completely. We were acting on a couple of deals in the retail sector, which have fallen away because the businesses are going through a severe difficult trading period. I think also the number of new opportunities we're seeing has significantly dropped off, and again that's probably not surprising. And even those sectors or businesses in sectors which are trading reasonably well, and indeed in some instances are trading better in the current time, some of the tech businesses, online retail, etc. I still think transactional activity is pretty limited. So there is a sector dependency, and I would say over the last couple of weeks, there are a few signs that businesses are looking to see what things are out there. They are potentially looking for opportunities, and there are signs of a little bit more activity in the M&A market, but it's still very early, and I don't think there's really going to be much of an upturn until, I'll be interested to hear what Ian, Simon and others think, but I don't think probably until the autumn or even later. Having said that, I'm trying to put a bit more of a positive spin on it, and as we've discussed in previous seminars, or webinars, I think it is an opportunity, and there are opportunities out there for ambitious, innovative, dare we use the word opportunistic, businesses and entrepreneurs who have money in their pockets. Without doubt, it can be a great opportunity to consolidate in your particular sector and possibly acquire one of your competitors who hasn't traded so well, or hasn't fared so well during the current crisis. And indeed, there may be opportunities to diversify your business, and possibly as a sort of defensive tactic, but to provide greater business bandwidth and some balancing, strengthening by looking to diversify some of your business activities. Then, of course, there's private equity. As we know, they've got plenty of money to invest, and they can't sit on their hands for too long. That's not how they make their money. So, without doubt, they will be looking for bolt-ons for some of their existing businesses, and I think increasingly they'll be looking for new opportunities once they've shored up their existing portfolios, which I think they've pretty much largely done. So without doubt, there is money there to put into the M&A market when people know where things are. And I think that's where there is quite an interesting conflict to a start. I think the market is going to have to take some time to understand where the new pricing matrices are. There is a danger that the gap between buyers and sellers may be greater at the end of this period. And everyone will need to understand where multiples of value sit in the new post-COVID transactional world. But I think the interesting thing is also that there will be sellers out there who may have been considering some disposal process or some exit prior to this crisis, who, if their business gets through this, that shows inherent value, that shows rigidity, that shows their business is robust, who may actually consider selling at a lesser price, because I do think one of the byproducts of this is there is a shift in personal perspective. And I think business owners may want or may be prepared to sell at a reduced price, as ultimately the ultimate value achieved is measured against longer term personal values. So I think it'll be interesting to see how that plays out. But when the M&A market is actually going to pick up again, interested to hear Ian, Simon and others' views, but I can't see much really picking up in a significant way before the end of the summer at the earliest. Looking at the administration, pre-packs, that sort of stuff, again, it hasn't been as busy as many people thought it might have been at the beginning of the lockdown period, but there's an obvious reason for that. A number of businesses have hunkered down, even sort of mothballed, relying on the government support schemes of the furlough arrangements, the loan schemes, tax deferrals, etc. And therefore they are surviving. But it may just be that. They are really just surviving, and they're almost delaying the inevitable. As we know, furlough is a grant, but the rest of them are money that has got to be repaid at some point. And I think the danger is when we come out of lockdown, many companies may find the damage done to their business is too great for them to be able to recover. And although their underlying business may be strong or may be viable, creditor pressure and damage to cash flow will require some form of administration process. So I think there's no doubt that Simon and his team are going to be very busy. Again, when that is, listen to Simon's view, but I would guess that's going to be August or towards the end of the year, where there'll be a deluge of administration work, I'm afraid. Trying to put a more positive spin on it, there were, in certain sectors, some businesses who, even with government support, couldn't survive. Obvious examples being, as I say, retail, hospitality, travel, those sorts of businesses really struggled. But again, trying to put, as I say, a positive spin on it, we've acted as a couple of examples for clients in those sectors who have actually seen it as an opportunity. There is one who was in the hospitality retail sector, who was a provider of high quality food and produce to the hotel and restaurant sector. Clearly that fell off a cliff pretty quickly when lockdown started, but they were flexible, adaptable enough to change their business model completely and provide those sort of goods to consumers direct. That has meant that their business actually has thrived. They're doing extremely well, and they are now looking at picking up some of their old competitors because they need more space, they need drivers, they need bandwidth, etc. So that's a good sign of a business being adaptable and flexible that actually has turned a negative into a positive in the current environment. And the other is a client of ours, a well-funded overseas business in the travel sector, who was concerned about their supply chain. So instead of worrying about it, what they've gone and purchased a couple of companies further down their supply chain to ensure continuity of supply to their ultimate customers. It's cut out the middleman, it's taken some of the risks away, And again, they see this as a real opportunity to change their business model and to take their business forward on a different way. So there are opportunities out there. The market is still quite tough, but I think we're all hoping that things will pick up towards the end of the summer. I think Simon and his team are going to be busy, as I say. But on that note, I'll hand over to Sarah.
Thank you, Adam. So today, Simon and I will be discussing the pros and cons of buying a business from administration. Next slide, please. So there can be advantages of buying a business out of administration, and it is almost inevitable that in the current crisis, many businesses will go into administration or other form of insolvency process. Now, this could present a great opportunity for companies that are commercially viable and keen to consolidate or expand their offering, or diversify or take over competition, as the price paid post-COVID may be a fraction of what they would have been if they'd been looking to acquire the business in January 2020, and the business they were acquiring had been fully operational. So you could get a cracking deal. And as you know, most of the liabilities to the creditors will stay with the seller. As the buyer, you can decide if you simply acquire the assets or take the entire business. To an extent, if there are no other bidders, then the choice would be yours. For some, the speed of acquisition is attractive. There's no shilly-shallying around. You sometimes see that complex acquisitions are turned around in a few days. And this means that whilst it is high intensity at the time, your management don't spend weeks, months or longer tied up in complicated negotiations, hammering out the finer point and nuance of every deal. You may wish to acquire the business as a whole, which would usually include the employees, giving you a ready-made workforce at a fraction of the cost of recruiting them from scratch. And for some buyers, that can be attractive. It can also be not attractive because you may not want those employees. But for all the advantages, there are potential pitfalls as well, and things can go wrong. Next slide. As I said, the process will move very quickly. If the assets or business is being sold via a prepackaged administration, the deal needs to be agreed prior to the appointment of an administrator during a period whilst there may be no moratorium. The company can only give notice of intention to appoint an administrator if there is a charge holder to give notice to. And if there is no charge holder, then every day pre-administration runs the risk that a creditor will pull the plug. This may be mitigated by the new Corporate Insolvency and Governance Bill provisions, but that's still in draft and has yet to pass through Parliament, so we will have to wait and see. If an administrator is already appointed, then they'll be looking for a buyer as quickly as possible. They will advertise, and you may not be the only game in town. The buyer therefore needs to be flexible and focusing on structuring a deal that works for them and the administrators. The usual comfort of the deal process and the time it takes to carry out that process is remarkable in its absence. So without significant negotiation and due diligence, the buyer is bearing all the risk, so your offer price should reflect that. There's unlikely to be much by the way of due diligence, but bear in mind, if there's a third party buyer and a connected party looking to acquire, then you should have access to the same information. If possible, ask to speak to the employees, not just the management or the directors. If you're buying a business lock, stock and barrel, understand from them where the product works or the business works and where it's gone wrong. If it did fail, was it simply over-leveraged at the wrong time, or has something more sinister happened to put it out of business? Ask the administrator detailed questions, preferably in one hit rather than one at a time, and understand that the information the administrator can provide cannot necessarily be relied upon, and there is no right of recourse against the administrator. Understand what you're buying. Is it the business or is it the assets? And does cheapie apply? Because that will have a significant impact in how much you want to pay. In terms of the employees, post-COVID, this could be a particular peril to be aware of and a key area of risk. You must understand what the risks and liabilities are for the workforce if they transfer across. Bear in mind, some may be on furlough, so the immediate picture of employees may not be complete. Cheapie may well apply depending on the structure of the business and the assets you're acquiring, which means that the employee contracts will automatically transfer to the buyer. If cheapie does apply, then certain informing and consulting obligations arise, and don't get it wrong, otherwise you, the buyer, may be liable for substantial liabilities and compensation claims to those employees. There won't be any warranties or indemnities from the administrator. The administrator is the agent of the company and will accept no personal liability in the sale contract. There'll be no warranties about the assets that are being sold, whether they're incumbent, whether ownership and the condition are satisfactory to you. So consider whether deferred consideration is appropriate, as this can sometimes be agreed with an administrator who wants to bulk sell all of the assets to one buyer rather than one off here and one off there. Check that the appropriate releases have been obtained by existing funders who may have debentures or charges over the assets that you're acquiring. Also check the terms of the administrator's appointment and make sure they have the relevant authority to sell those assets. I'll hand over to Simon now to discuss the buying process.
Thanks, Sarah. So I thought what I would do is just take you briefly through what the process looks like. It's very different to a normal commercial process, and with that, it goes very quick, and the level of information you get is significantly different to the normal commercial world. So how does it look? Early on, what we're looking at is obtaining non-disclosure agreements and putting information together into a data room. It won't surprise you to learn that that data room is fairly sparse in the information that's provided, and what we're looking to do is to collate key documents, leases, specimen employment contracts, customer lists, debtor and creditor lists, possibly redacted in order to protect the value of the business pending a sale. And we give those parties that have signed non-disclosure agreements access to the data room in order to review that information, probably just for a period of days. Following that, we're talking with purchasers, and we are providing some further guides to information, some dealing with some inquiries and looking for expressions of interest, and we'll do that in conjunction with agents. The access to data room to expressions of interest may be as short as 2 or 3 days. It may be as long as 7 or 8 days, which I appreciate isn't a particularly long time, but those are the timeframes that we tend to work in. Following those initial expressions, then what we're looking at is whether we can move to best and final bids. Essentially, separate the wheat from the chaff in terms of potential bidders, proof of funds, and understanding who are really there just to try and get a bargain versus who are seriously in line to purchase the business and have the wherewithal to do so. That Sarah talked about the due diligence side. There's always going to be a limit to the level of due diligence we can provide, simply by the fact that we've only been in the business for a number of weeks, if that. And actually, to the extent that we are able to provide information, we can't warrant its accuracy. All we can do is explain the limits of how it's been produced. So a lot of the time we'll be reticent to provide anything more than a reasonable level of DD. But as Sarah says, we need to make sure that we make available to all parties the same level of information as much as reasonably possible. And following best and final bids, we then obviously choose that best bid, and I will go on a bit later to talk about what a best bid might look like, but then we move on to negotiations of sale contracts. So in a pre-pack administration, all of this would be undertaken pre-administration. The contract would be negotiated and finalised in draft prior to appointment. We're appointed, and then the contract is signed. If we're in an administration itself and we're selling post-administration, the process probably could take longer, but the principles will still be the same. One of the key aspects for us is what we don't do is say, here are some assets, we'd like £10 for them. What we say is, here are some assets, make your best bids. We'll try and work them up in the background and try and get to the best offer that we can. Sarah, over to you.
Thanks, Simon. So some key things to look out for. The premises. In the short term, at least, the business may need to continue operating from its existing premises to continue trading. So check the existing arrangements with regard to premises, as you may need to conduct rapid negotiations with the landlord to ensure the continuity if you want those premises to remain. As the deal is likely to be done quickly, you're unlikely to get an assignment of the lease or a new lease. Therefore, the administrators will need to grant you a licence to occupy. And even then, if the lease has been breached, which is more than likely, the landlord may not allow the lease to continue, even if the rent is being paid. Although currently there is very little a landlord can do to enforce the payment of that rent if it's not being paid. The landlord may ask the administrators to consent to forfeiture, and the administrators may find it difficult to object if a court application is being threatened. Book debts. Are you buying them? Who owns them? If you're not buying them, then the price needs to reflect this. And remember, the administrator may continue to collect the book debts if they're being retained. And if they're collected in an aggressive fashion, that could upset your existing clients and your customers, which would belong to you now as the buyer. In terms of contracts, the supplier and customer contracts may not be novated on an insolvency event, and if they can be terminated, they may not be assignable. If a novation is required, the third party cannot be compelled to enter into the novation or a new contract with the buyer. Any stock could be subject to retention of title provisions, and valid claims could reduce the value of any stock substantially, whilst creating you, the buyer, a cash flow headache, as the suppliers have to be paid in full. The IP is important, so do check who owns it. Does it belong to the company, and are the IP licenses up to date and transferable? Know what you're buying and that you're protected on the key assets. I would also add check it works, preferably prior to purchase. It is not uncommon for administrators to be instructed to sell companies who spent years developing their product, and regularly the failure of an app to work or the high-tech piece of kit's failure is the cause rather than the result of the underlying issues that brought the company to its knees. Make sure you forecast carefully and sort out your working capital, and it's a wise idea to consider putting the assets into a new company so they're ring-fenced from your other company in case of any issues post-completion. And also be prepared to walk away if the deal does not look quite right. Simon.
Never walk away from the deal. I'll get you there in the end, don't worry. I think just to add to one thing Sarah said there, what is fundamental, what we find a lot of challenges with is companies that want to do the deal, have the wherewithal to do the deal, but don't have the infrastructure to take it forwards afterwards on day one. Things like bank accounts, VAT. So there's a lot of thought that ought to go in very early on to what vehicle you're using to acquire and what you will need to put in place in order to be able to take on a business or assets post-sale. So offers, it's an interesting area actually, and it's one where lots of people don't get it right, and they don't get it right for the wrong reasons. Actually, in a bizarre way, it's not complicated, and I think the key is in the bottom left of the slide there, being creative. But let me talk you through a few key aspects. The first is cash is king, and it is simply the most important part of how we consider a deal. Where we're being offered risky terms, conditionality, deferred monies, then a deal is immediately less attractive to us. And day one consideration, day one cash in the bank is a very important part of us coming to the table in order to be willing to do a deal. And when you have competing offers, you must reflect on the fact that actually the more cash you can put out on day one, the more likely you are to secure a deal in a competitive territory. So where do those deferred terms come in? That tends to be where they can be linked to day one cash, and also to the extent reasonable, made certain as opposed to conditional. So for example, it is perfectly reasonable to make an offer that says we'll pay you 50% up front and 25% over the next 6 months and another 25% by the end of the year. That is an entirely workable offer. Now, if we get offered 80% of that up front, there is a possibility we'll take that 80%, because there are risks involved, obviously, in having deferred consideration. But at the same time, if we're looking at two bids where one is conditional, deferred terms are conditional on turnover in the future, then that is discounted to a high rate when we're comparing bids, simply because of the risk of those funds not coming in. And you will find that very, very clever people, much smarter than me, like Ian and Adam, will spend their time figuring out the level of turnover that means that in reality, no further consideration will ever be paid. So I'm wise to that. You watch out. In the sense of deferred terms, reasonable period, a year, maybe 2 years. But one of the things you have to remember is that where you're not offering all the money up front, where there is risk to us doing the deal, then what we need to be careful of is what security we take, whether we take fixed and floating charges over the purchaser, whether we take personal guarantees, and to what extent a purchaser has an appetite to grant those, especially a PG. So that needs to be considered in the context that if you want to go and finance those assets after you've bought them and you've had to grant us a debenture because you've offered us deferred terms, that may provide problems. All of that needs to be thought about along with your lawyers, along with your advisors. Going back to being creative, it's absolutely key. Sarah mentioned the book debt side, and actually most people don't think that they can buy book debts. They just don't think that they're a possibility. But if you think about it for a moment, it makes absolute sense. I'm inheriting a business that I have no previous background in. I'm not a specialist in that industry. If you're a buyer who knows that industry already, knows the players, knows the customers, and is going to continue providing services to those customers, then you're likely best placed to collect those book debts. So if you're offering to buy them off me for a percentage of their value on day one, or you're saying, actually, we'll act as agent to collect those out and we'll take a 15% commission, all of those things can be considered. So don't be afraid to push boundaries and ask questions. We are, by our nature, commercial animals. We want to get the best deal we can, and we're willing to look at innovative ways that works for all parties. So being creative, ask those questions, see what you can do. And fundamentally, understand your bottom line. One of the keys to buying in an administration scenario from a distressed business is that you're likely to be getting a good deal by the nature of pricing and risk. But you need to understand that risk along with your advisors. You need to understand what potential costs you could be inheriting, such as TUPE, and therefore know how far you're willing to go in terms of offering consideration. But don't then penny pinch on the back of that. If you're actually willing to offer an extra 5,000, my advice would be offer it. Don't think you can offer less than that in the best and final and hope that I'll come back and have a further conversation with you, because you will be sorely disappointed most of the time. So make your bid as good as it can be, but understand the price at which you're simply willing to walk away and move on to the next thing. Sarah?
Thanks, Simon. So as Simon says, the IP is just as new to the business as you are, and at best they may only have been advising for a few weeks, so they won't know the ins and outs and finer details of, and they will be under enormous pressure to sell off the assets or the business of the ailing company, because frankly the quicker they do it, the more likely they are to get a deal. As the buyer, you need to understand that the process is not perfect, and you have to get comfortable with an element of risk. There is only so many times your solicitor can expect the reply to his inquiry to be a, sorry sir, we don't have that information, before the IP gets to the point where they're refusing to deal with you because they don't think you're a serious buyer. IPs often get an independent valuation of for the business to ensure that the offers they are considering are in the right ballpark. This may be difficult post-COVID, as values may have changed significantly and the business world may not have caught up with what those values might be. At the moment, it really is finger in the air. The IP needs to ensure that the process as a whole is transparent for all bidders. Whilst naturally any connected party, such as the in situ management team, will have better information available to it, that does not stop the IP ensuring that the non-connected bidders are provided with that information as far as possible, and the same information in a transparent process. Now, you may not get unredacted employee lists and the management team will know who those employees are, but you should, as far as possible, get the same information. Likewise, it will help your process enormously if you instruct a solicitor with a specialist insolvency knowledge. The IP won't have time in this high-intensity process to walk your solicitor through the deal in baby steps, all whilst providing a bucket full of information for you to be comfortable with. So therefore, ensure that you are comfortable with the inherent risk involved. And if your solicitors are familiar with the process, then they will be able to give you that comfort. Finally, remember the IP is acting in the best interests of the creditors as a whole and trying to ensure that any deal that is done results in the best and most certain return for creditors. As Simon says, if you offer more cash up front, then your offer is more attractive because the creditors have some certainty that they're going to receive that cash. Next slide, please. So a cautionary tale. This is a case about how not to carry out a pre-pack administration. And I'm sure the administrators would, on reflection, wish that it had never darkened the door of Mr. Registrar Jones's courtroom in the Rolls building. VE Interactive was a company in trouble. On the 3rd of March 2017, under the terms of a settlement deed, the company jettisoned its former controlling director and an investor injected £3 million into the company and took practical control. A new management team were appointed and they swiftly realised that it would need to raise at least £20 million in capital to keep the lights on, pay the immediate bills, and a further £20 million to put the company into a strong financial position. Between the 3rd of March 2017 and the 13th of April 2017, the directors and the management team tried to raise the first £20 million. They failed. But during this period, 2 of the directors formed a new company called Rochester, which was subsequently used for the pre-pack purchase. On the 10th of April, the directors met the potential IP to advise on options, and they all concluded that a pre-pack sale was best. The retainer was delayed for 3 more days, whilst the directors scrabbled round the back of the sofa looking for £20 million. They didn't find it. Sadly, for the IP at least, the sale was not straightforward, and it was urgent. The IP required financial information to pass on to other potential purchasers. The directors delayed in providing the information. There were issues over what could and could not be sold, including a US company which provided 30% of VE's turnover and had been identified in the company's last set of accounts as a subsidiary. This was considered incorrect by the new directors and management, but it was clear that it was key information to any potential purchaser. The first time the IP identified another potential purchaser other than Rochester was late on the 20th of April 2017. There was a further delay in providing the third party with the financial information, and when it did turn up, it was deficient and was not what had been requested. Therefore, the connected company, Rochester, had a significant head start and information that was not available to the market. The IP had advised that Rochester alone that upfront consideration in the region of £2 million would be needed for the sale, but did not think to tell the third-party bidders this key piece of information. Any potential purchaser needed to make an offer before the 26th of April 2017, which would be based on deficient information and with no memorandum of sale describing exactly what was being sold and dealing with the point about the US subsidiary. None of this was disclosed by the IP to the court when they made their application for an administration order. On the 26th of April 2017, a pre-pack sale of VE's business and assets went ahead to Rochester for £1.75 million. Clearly, there was cause to investigate as the lack of transparency, the failure, albeit caused by the tardy and deficient provision of information by the directors, and to provide information on an even-handed basis to all bidders, and the whole multitude of other breaches of SIP 16. The IPs, though, remained in office, declaring, as it were, "Nothing to see here, move along, please." Upon an application to the court by some of the major creditors that the IP resign on the basis of a conflict of interest, Mr. Registrar Jones was searing in his criticism of the IP's actions, which culminated in them attempting to resign after giving evidence on the 6th day of the trial. It doesn't sound as if their evidence went very well. Mr. Registrar Jones concluded there were a number of matters that required investigation, including whether the business was marketed with proper due diligence, whether the directors were able to and did take advantage of the financial and sale information which they kept to themselves, whether the process and lack of information effectively excluded the possibility of competing bids and therefore a genuine market upon which a level playing field would be formed, and accordingly the IP's role in the whole process. Mr. Registrar Jones removed the IPs with indemnity costs against them, together with orders that their costs in the administration may also be wasted. I suspect the judgment also involved a complaint to their regulatory body. the case went spectacularly wrong. So when buying from an IP, do try and ensure above all else the even-handedness of the approach. And if you are the in situ director hoping to scoop up the company on a cheaper basis than you otherwise might have paid, remember, if you do not play fair to secure your own advantage, it may well come back and bite you in the future. Over to Simon for his view on the current economy.
Thank you. Before I go there, I think just to reiterate a couple of points that Sarah made. That's a fairly unhappy case in the sense of being an IP and conducting a procedure, and actually it's very clear that we have a fundamental role to play in ensuring the equity is maintained, the equilibrium is maintained when we're making a sale. It is important that the directors provide the right level of information. We ensure that, and we also ensure a level playing field for a sale. Sarah's point about lawyers and advisors is absolutely right. My first advice to a potential purchaser of assets is you need to get lawyers who know what they're doing, because this is not a normal commercial deal. And if you try and put in lots of boilerplate clauses, then you're going to spend a lot of money with your lawyers for no purpose whatsoever. So having lawyers like IBB on a case is extremely helpful, because quite simply they know what they're doing, and it makes everyone's life a lot easier. So Adam gave the lawyer's view on the economy earlier, which I don't think is going to differ much from mine, actually. I think a few key points, really. The first is that I've never been in a time period where people have started conversations with, you must be really busy and I'd like to speak to you about a case, but do you have available time? First of all, IPs are never too busy. That's the first rule of life. But it is true to say that over the last couple of months, the industry hasn't been as busy as most people think, because the levers that have been used by the government in order to support businesses. What we have seen is an early proliferation of companies who were very cash hungry, who weren't able to continue in a very short period of time without generating revenue, which had been severely inhibited by lockdown. So some of those businesses, some retail businesses, some in the travel industry that simply couldn't cope, have gone into a process. But it won't surprise any of you to learn that for a number of those businesses, we're in a situation where they weren't doing well beforehand. The likes of a Debenhams was a business that had already been in a CVA, had already had huge amounts of problems, and actually one of the types of businesses that we're seeing and we're likely to see more of is those businesses that fundamentally weren't sound before COVID-19 hit, but essentially it's the largest straw that ever broke a camel's back ever in terms of those businesses not surviving. Where there is a fundamental change, and what we are expecting to see, is businesses that were viable and were successful before COVID-19, but as a result of both the significant impact of lockdown, but also the long-lasting impact of whatever social distancing may look like months from now, those businesses have moved from something which was successful to something which is threatening not to be viable. And if I can give an example of that, at the moment I'm advising a business which was delivering £1 million EBITDA 6 months ago, and now is facing closure if it can't get it right. So the timing, I think, is absolutely right. As Adam says, I think come the autumn, moving into 2021, you're going to see more businesses that fail. I should be clear, though, that when I say you're going to see businesses that fail, there will be some businesses that fail. There will be more companies that don't survive, but actually the businesses within them, through processes such as administration and the buying processes we're discussing here, they will cause the business to survive, perhaps not in the same shape or form that it was before. I think a lot of businesses will be trimmed down for a number of different reasons, but but I think there will be a lot of companies, through debt on their balance sheet, through the challenges that they've faced, who go through some form of restructuring process of CVA and administration in order to come out of the other side in the right way. And where that brings opportunity for fresh third-party buyers is those businesses that actually management may not have the wherewithal to buy back, because actually if the business is trimmed down, it's a valuable asset. It has valuable assets, and actually it requires third-party funding, or indeed it provides an extremely level playing field on which third parties can come in and make reasonable bids for assets. There is, by its nature, always an advantage for an insider bidder, because they have more access to information by the fact that they've been involved in the management of the business. But actually, I think there's going to be more pre-packs, there's going to be more opportunities to buy businesses and assets out of administration that have real value over the next 3, 6, 9, 12 months. And I think, the impact of changes to furlough, the impact of the next rent quarters, directors simply don't have a level of comfort that means they can just continue incurring debts for the foreseeable future and not worry about having to take action. So there, unhappily, there is a mix that's likely to lead to quite a significant number of companies at least utilising insolvency legislation, moratoriums, CVAs, administrations to restructure their businesses. Ian, over to you.
Thank you to each of Adam, Sarah and Simon there for their thoughts. Just a reminder to people, we've got about 10 or 15 minutes to go through questions. So if people who've got questions, please do use the Q&A function and submit those. Whilst you're doing that, I'll just reference a couple of thoughts from listening to those comments myself. I know there was some talk there of views of the M&A market, and from my perspective as a corporate financier, I think what's clear is that institutional investors, so banks, private equity, venture capitalists and the like, have largely spent the last sort of 8 weeks or so reviewing their portfolios and their existing investments and assessing, cash needs in those businesses, opportunities for those businesses that might be created, such as buying businesses out of administration. And Simon and I advised a private equity portfolio business a couple of weeks ago on making a discrete acquisition from an administrator in just such the terms that's been talked about today. So I think we'll see more of that. But what is true is that I think that those equity institutions are certainly reopening for new opportunities. I think that will be with a great deal of caution, and I think that will be with an eye to valuation and much lower valuations than perhaps we have seen, or certainly we have seen in the recent years. And for those businesses that are trading relatively successfully, they will be undertaking as much due diligence as they can in that period to take as much comfort as they can around sustainability for those businesses going forward. My view always is that dislocation in the market creates new opportunities for investors. And looking at what happened post 2008, there was a lot of those such opportunities, and the current crisis will only offer more of those for investors. Just picking up a couple of quick comments on offers and processes. I would say don't underestimate when you're making an assessment as to what you're acquiring and how you're acquiring it and how you're going to fund it. And Simon talked about, cash is king. Absolutely, don't forget the working capital needs that business will take on as you bring it into your own organisation. And I can't emphasise strongly enough the need to do 13-week cash flows and thinking very carefully about the first few months post-acquisition and what funding that new acquisition will need. And equally, don't underestimate the time of your own management team that it will take to make that a success. Post-integration management is a hot topic in good times as well as bad. You know, lots of people talk about things like 100-day plans and things like that. You won't necessarily have that amount of time, so moving quickly and moving decisively as a management team will be key over the coming months if you're looking to make acquisitions. So thank you for everyone to take us through their considerations and thoughts and observations about the current situation and the market dynamics. These transactions, I would say, are just not like normal deals. They require an understanding of where risk and reward lies for the acquirer. And because those timeframes are so often highly constrained, the need to take professional advice in a timely manner is critical to achieving the best outcome possible. So we've got a few questions. So if perhaps Sarah, the first one I'll put to you. I'm going to buy the physical assets from a company in administration. I understand the DD may be limited and I guess access may be limited in current lockdown as well. What areas should I focus in on?
Well, and if you're looking at the assets in particular, you know, make sure that the asset register is up to date. So your administrators probably just have a list of what those assets are. They may have sent a value around, but unlikely at the moment in lockdown. So if it's possible, maybe go and have a look at them, because once you've looked at the charges register, you've checked any encumbrances, you've made sure if there's any funding on them, how's that secured, go and actually look at things. I've dealt with cases that, for example, involved a waste transfer station and the various parts of its transfer line, all owned by different people. One person thought they owned the lot, and you actually went and had a look, and all the identification numbers had been filed off, and it was almost impossible to know who owned what. You know, if you're trying to acquire assets like that, then it makes life very much more difficult if you can't identify what you're actually buying. So that would be a really top tip if that's the sort of acquisition you're looking to make.
Thank you, Sarah. But perhaps if we just move on to sort of looking at the offer process and a couple of questions on that. Adam, perhaps the first one to you. How inventive must I be, I guess, when I make the offer? And given it's so quick, what sort of things do I need to cover off in making that offer itself?
Well, I was very interested to hear Simon's thoughts on that. I mean, clearly, as Simon said, cash is the fundamental, and the more you can give up front, the better. Clearly, deferred elements of consideration will be acceptable. As Simon said, over, I would say, sort of 12 months is sort of the maximum period for any element deferred. I think it's interesting the discount that Simon said they put on any sort of earn-out basis, because as Simon also alluded to, you know, that can be structured to make it that the earn-out is pretty unlikely to be paid. And I think even in a normal M&A process, when we're acting for sellers, we would always say, basically, assume you're not going to get the earn-out, but make sure you're happy with the upfront element. I think, as Sarah was alluding to, the most important part of this process is to fully understand what you're buying, and that's absolutely key. We've acted on a few of these recently where the asset list wasn't clear. It wasn't, you know, no one really had it, and for understandable reasons, it's not the IP's fault. As Simon said, they've only been in the business for a couple of weeks, and there's only so many notices of intention they can put through. So there's only limited time for people to really understand what's there. I think the other really important thing to bear in mind, which you alluded to, Ian, is who else is involved in the process. Because if there is a management team who are potentially in the process, they may have a PG, which will mean that they are possibly more keen and in a better position to acquire. So I'd be interested to get Simon's view on what information you can give other bidders about what bids are out there, if you see what I mean. If you're coming in as a third party, will you provide information as to what the other bidders are? Clearly you can't give what their offers are, but information as to what bidders are out there. So I think it really is getting a very clear feel of what assets you're acquiring, putting as much element on the upfront cash bid as you can, And I think what Simon said is so true. Don't penny pinch. Come up with your best offer up front. Don't try and keep a little bit in your back pocket, because you might lose it for that, and that would be a real shame. To nickel and dime and lose it for £5 here or 10 grand there would be a real shame. So really understand what your offer can be, make it as much upfront cash as you can. And again, Ian, your point, absolutely right. Make sure you understand what it's going to cost you to run the business going forward. Because clearly what you don't want to do is buy something and realise then you can't fund it going forward. You haven't structured it. The post-deal integration isn't running properly, etc. So it really is a case of understanding what you're buying and structuring something that is attractive as it possibly can be to the IP. Simon, I'd be interested in your... Yeah, sorry.
Yeah, sorry, Adam. I mean, it's funny doing a webinar like this. It kind of makes me think about things from a different perspective, but also I live in this bubble of what I do, and I'm very used to this process. And then actually, working with Ian and seeing his way of working, seeing the normal corporate finance in a normal commercial environment, and then reflecting on what that looks like in my world. Actually, one of the things that I haven't said, which would probably be just useful to mention for a second, is you've got to understand the psyche of who you're dealing with. And that's me in this scenario. And the point there is that, and I've heard Ian talk about this and my other corporate finance colleagues, the aspirations of the vendor. The corporate finance teams having to manage both a potential purchaser but also the seller's expectations of what that looks like. I don't have expectations. I don't have that same level of emotional investment in what I'm doing. What I need to do is make sure that I achieve the best out of the process. And my bottom line to that is what would happen if I went into liquidation and sold the assets on a breakup basis. If I beat that price, then anything I get on top of that is extra for the creditors. And so it very much then becomes back to this point of who else is out there. What I require to have a successful process is commercial tension. I require parties to be nervous about what anybody else is bidding, because I don't get to just sit there and say, look, the assets are 50,000. If you pay me 50,000, I'm happy, because that's not how our world works. So the likelihood is that the best you will get from an understanding in this process is numbers. There are 3 other parties who are near your price, and you need to sharpen your pencil when it comes to best and final bids and put your best foot forwards. Ultimately, what I'm looking for is the same thing that I've advised here. It is the fact that just go as high as you reasonably can. And in the sense, be very clear, and I know you do this with your clients, be very clear about having those discussions with your advisors and saying, well, come on, what are the risks we're facing in going into this? What is the TUPE liability that we're risking? What are the risks that we're going to have a litigation over the assets afterwards? How do we price that all in, and what is our figure? And the case that Ian and I dealt with recently, I kind of bluster in there on day one and completely reset the agenda, because I sit there and say, whoa, stop everything we're discussing. Let's discuss first what we're buying. What we're buying is an opportunity to go and secure future contracts with customers. That's all we're getting. We're not buying assets. We're not being able to touch these things, and we're not buying an asset that is assignable to us. This contract doesn't exist the day afterwards if the customer walks away. So we first need to understand what it is we're trying to buy, and then price it accordingly. And the simple answer is you just won't get a lot of visibility. Agents who act for us in those sales, their role is to liaise with us, to liaise with purchasers, and to try and get the best bids possible. To the extent that we have an interesting set of purchasers, we will engage as much as we can in conversation, and we will try and nudge people and give them helpful information, but we'll never be saying, look, if you have an extra 5 or 10 grand here or there, then you'll win. Because we need to be careful, going back to Sarah's point about VE Interactive and that level playing field. And if you'd have told me what you told them, then I would have made you a different offer, which is why we're careful on deadlines.
Will you say if there's a management team involved?
Yeah, absolutely. And indeed, actually, interestingly, I've been asked that question. I was quite surprised the first time I was asked that, because someone actually said to me, look, can you just tell us if we're wasting our time? On day one, they asked me that question, and I'd never heard it before. And when I reflected on it, I thought, actually, it's quite a fair question. But I have, the point you make is absolutely right. That point about PGs and understanding whether there is a reason why another purchaser can outbid. So, for example, I did a sale of assets where there was one of the purchasers was a fixed and floating charge holder with 6 million of debt. The assets weren't worth anywhere near 6 million quid. So you knew that unless he decided to cash out, he was going to buy them. You know, unless he got an offer of 2 million and he thought, actually, I'll take that rather than buy them myself, he was always going to be the purchaser. And I would absolutely make that clear to purchasers. But on the flip side of that, I've also threatened to walk away from pre-pack when the director did want to buy the assets. And I was told by third-party purchasers that he was being actively unhelpful in engaging with them and providing information. And that is absolutely where you, in conjunction with your clients, keep the process honest. You know, going back to Sarah's point about that level of DD, you can absolutely bite at my heels to get DD, and I will give you what I can. But at the same time, what that will also do is make me think about, am I giving the right level of DD to the same parties? Am I giving everybody a level playing field? And that's a valuable part of the process.
And I think we had a question from Jonathan, which hopefully, Jonathan, we've sort of answered that in various ways, which was around about what information can we get around who others are viewing and bidding for this business. And I guess one final comment that I would make on that, and this is coming very much from my perspective as a corporate financier, and as Simon says, I'm always conscious about people's feelings and expectations. One thing that is very clear is that in these sorts of processes, being direct, being upfront, being very clear is actually valued by all sides, and in particular the IP, because they're looking to make a decision. Typically, their option is not to retain the business, so they are looking to execute a transaction to best value for the creditors. And so, you know, they're keen to share information where that will enhance the process and quite frankly, not beat around the bush like people like me would do in a normal sale process where we're trying to manage expectations, chip up the value, and you know, maybe have a longer time frame to execute a deal than would be in this sort of administration type process. We're coming to the end of our hour. If I was just going to ask for 30 seconds from each of you, perhaps to get your crystal balls out and a final view as to perhaps over the next 6 months, and as government schemes change and furlough changes and perhaps VAT starts to be repaid and the like, you know, what do we see as towards through the back end of 2020 and the start of 2021 as things to look out for? And key timeframes for businesses to be conscious of. Perhaps Adam, maybe just 30 seconds each if you can.
Well, I think certainly Simon and his team are going to be busy towards the end of this year. You know, it is the classic coming out of that lockdown period, coming out of the government assistance plans, etc. There are certain dates that we all need to be aware of around, you know, when the furlough periods come to an end, red payment dates, etc. So I've got no doubt that's going to be busy. I think what is going to be interesting for us, Ian, is the general M&A market and when that picks up, because there is a lot of cash out there. And I generally believe, as I said, I think some sellers who've got a business who have got through this will get through it and say, I just want to get out now. I've had enough. You know, I don't want to go through this again, because I do think this whole process has made people look at things in a different way. And maybe by then I might have a proper beard as well.
I think from my point of view, I do a lot of litigation, and I think it's very important to understand that the process is very clear. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear that the business is going to be sold. It's very clear Where companies go wrong and go really badly wrong is where the directors don't follow general rules of good management and documenting their decisions, because at the moment you are making a lot of decisions based on very limited knowledge of how long, the furlough scheme is going to taper off in October. You may be deferring rental payments, VAT payments. You might be even not paying your own personal tax at the moment. And it's a good idea to make sure you've got those decisions documented, because if you do then have to go through some sort of process later, whilst you may not be under the new corporate insolvency bill be looking at wrongful trading allegations, there are still allegations of misfeasance, etc., that you may face. And if you haven't documented things properly as to why you've taken decisions and why it was a good idea at the time, then you may find that your life is much more difficult compared to somebody with a decent set of books and a very well organized filing system.
I've learnt recently that the more I say on what the future looks like, the more depressed people get. So I'll keep this as brief as possible. The one thing I would say actually is I think there's been a fair amount of misinformation around directors and directors' duties. I think that the suspension of wrongful trading sent out the wrong message and is not helpful to businesses managing and trying to understand what they're meant to be doing through lockdown and beyond. Generally, I think VAT quarters probably historically now have been a moment of pain, but assuming the businesses haven't got revenue, then they're not likely to cause them too many issues. It will come down to rent quarters, which automatically add overhead, and actually monthly salary bills when the furlough scheme drops away. So I think fundamentally now, as the fog clears, I think that's a phrase I've used before, on what the world is likely to look like, directors are going to have to start making tougher decisions on whether they have viable businesses with their balance sheets and whether they're going to be able to service the debts they've accrued. And that, almost arguably every day, depending on the business and depending on the sector, is going to be key.
So, okay, thank you. Well, as the fog clears, I'm afraid the sun has come down on us. So that's all we've got time for. But thank you for everyone who's joined us for this series of webinars. Hope you found the topics and speakers as we've hosted between Quantuma and IBB Law helpful as you navigate through this pretty dynamic business environment. At Quantuma, we run a regular webinar series on Fridays, so please do check out our website for updates and further information on those. And all of the previous webinars in this series and further information is available both on Quantuma's and IBB's own websites. So lastly, thank you very much to our speakers today, and also to the speakers in the previous two webinars as well, for both their interesting and engaging discussions and sharing their knowledge, expertise and experience. So with that, have a good day everyone, and continue to stay safe. Thank you very much.
Thank you.